The state pension change in 2026, pushing millions into income tax. Here is a number that should concern every pensioner in the United Kingdom right now: £22. That is the gap, as of April 2026, between the full new state pension and the personal allowance, the point at which income tax kicks in. £22 a year, less than 43 pence a week. That is all that stands between 12.5 million state pension recipients and their first income tax bill. And here is the part that doesn't make the headlines. The personal allowance, that £12,570 threshold, is now frozen until April 2031. It is not moving. But the state pension, driven upward every year by the triple lock, absolutely is. Which means that within the next 1 to 2 years, possibly as soon as April 2027, the full new state pension will cross that line. And millions of pensioners who have never paid income tax in retirement will suddenly find themselves in the system. In this video, I'm going to show you exactly what is happening, who it affects, when it hits, what it costs, and, critically, what you can do about it before HMRC sends you a bill you weren't expecting. And I promise you, by the time we reach section 4 of this video, there is a specific group of pensioners who are already paying more tax than they realise right now. If that's you, this video could save you thousands. Stay with me. Section 1. What is actually happening? The numbers. Before I show you who gets hit hardest and there is one group in particular that is in a significantly worse position than everyone else, let me lay out exactly what is happening with the numbers. Because understanding the mechanics is what makes the planning possible. The new state pension from April 2026 pays £241.30 per week. That is £12,547.60 per year, a rise of 4.8% from the previous year, driven by the triple lock earnings growth figure. The personal allowance, the amount of income you can receive before paying any income tax, is £12,570 per year. It has been frozen at that level since the 2021 to 2022 tax year. And under legislation already passed, it will remain frozen at £12,570 until at least April 2031. The gap between those two numbers, just £22.40 a year. Now here is why that gap matters so much. The triple lock guarantees that the state pension rises every year by whichever is highest: inflation, average earnings growth, or 2.5%. The minimum annual rise is 2.5%. 2.5% of £12,547 is approximately £314. The personal allowance is going nowhere until 2031. So even in a low-growth year, a year where the triple lock delivers only its 2.5% minimum, the state pension rises by around £314. The personal allowance stays at £12,570. By April 2027, the full new state pension is projected to be approximately £12,861 per year. That is £291 above the personal allowance. Every penny of that £291 will be taxable income. And by 2031, when the personal allowance freeze finally lifts, assuming it is not extended again, the state pension is projected to be somewhere in the region of £14,000 to £15,000 per year, meaning up to £2,000 or more above the personal allowance, with up to £400 per year in income tax owed by pensioners whose only income is the state pension. This is fiscal drag, and it has been quietly pulling more and more pensioners into the tax system every single year since 2021. Section 2. The government's promise. And the catch. Now at this point you might be thinking, wait, I heard the government was going to protect pensioners from this. And you are right, they did make an announcement. In the 28-25 autumn budget, the Chancellor confirmed that pensioners whose sole income is the basic or new state pension will not have to pay small amounts of income tax by a simple assessment from the 2027 to 2028 tax year onward. That sounds like a solution. And for one very specific group, it is a partial one. But here is the catch, and this is the part of this story that has not received nearly enough attention. That protection applies only to pensioners whose sole income is the state pension. The moment you have any other income, any private pension, any workplace pension, any savings interest above the personal savings allowance, any part-time earnings, any rental income, you fall outside the protection entirely. You are back in the system. You owe the tax, and you have to deal with HMRC to pay it. According to figures obtained by pension consultancy, LCP, from a Freedom of Information request to HMRC, approximately 8.8 million pensioners in the United Kingdom are already paying income tax. More than 1 million of them are in the 40% higher rate bracket. So the protection helped the smallest and most vulnerable group, those with absolutely no income beyond the state pension. For the majority of pensioners, those who did the responsible thing and built some private pension savings alongside their state pension, there is no protection at all. And there is a second catch, one that creates what financial experts are already calling a cliff edge. The old basic state pension, paid to those who reached state pension age before April 2016, pays £184.90 per week from April 2026. That is £9,615 per year, well below the personal allowance. But many older pensioners receive additional state pension on top of their basic amount, SERPS S2P, graduated pension. When you add that to the basic amount, many older pensioners are already above the personal allowance, and they don't qualify for the government's protection because their income isn't simply the basic state pension without increments. In other words, younger retirees on the new state pension get the partial protection. Some older pensioners on the basic state pension plus additional elements get nothing, and are already in the tax system now. This cliff edge between those protected and those not is one of the defining unfairnesses of the current situation. Section 3. Who is already being taxed and doesn't know it. Now I want to stop here for a moment, because I said at the start of this video that there is a specific group who may already be paying more tax than they realise. And I want to be direct about this now. If you are receiving the state pension plus any of the following, a private pension, a small workplace pension, savings interest, even a very small amount of rental income, there is a genuine chance that HMRC currently has the wrong tax code applied to your pension, or that you are receiving a simple assessment bill you don't fully understand. Here is how the tax collection works in practice. The state pension is paid by the Department for Work and Pensions, without any tax deducted at source. There is no pay on the state pension payment itself. It arrives in your bank account in full every 4 weeks, but it is still taxable income. So HMRC collects the tax on it through one of two routes. Route 1. If you have another pension that is paid via pay, HMRC adjusts the tax code on that pension to collect the tax owed on your state pension. The result is that your private pension is taxed more heavily than it should be on its own, because it is also collecting the tax on your state pension. This is where tax code errors become extremely expensive. If HMRC applies the wrong code, you can end up paying significantly more tax than you owe. And unless you check your code and challenge it, that money simply sits with HMRC. Route 2. If you have no other pay income, HMRC sends you a simple assessment. This is a letter that tells you how much tax you owe and asks you to pay it. Research from the Low Incomes Tax Reform Group found that most pensioners receiving these letters have no previous knowledge of what a simple assessment is, how it is calculated, or why they have underpaid tax. If you are in either of these groups, and millions of people are, I want you to do one thing after watching this video: check your tax code. I covered exactly how to do that in my HMRC tax code video, which I will link at the end of this one. It takes 10 minutes and could reveal that you are overpaying, so we have established what is happening, when it hits, and who is already caught in the system. But here is the question I want to spend the rest of this video answering. What can you actually do about it? Because there are 5 specific practical actions that can either reduce your tax liability, eliminate it entirely in some cases, or at the very least make sure you are paying the right amount rather than more than you owe. And the third one on that list, which I will get to in a few minutes, is one that most people have never heard of. It is perfectly legal, costs nothing to implement, and could save you several £100s a year in tax. Let us get into it. Section 4. 5 actions that reduce or eliminate the tax hit. Action 1. Check whether you actually owe any tax at all. This sounds obvious, but given the complexity of how state pension tax is collected and the volume of tax code errors in the system, the first step is simply to verify that your tax position is correct. Add up all your taxable income from every source, state pension, private pension, workplace pension, savings interest above your personal savings allowance of £1,000 for basic rate taxpayers, any rental income, any employment income. If that total is below £12,570, you do not owe any income tax, period. If your tax code is producing deductions that suggest you do, your code is wrong and needs challenging. Call HMRC on 0300 200 3300 or log into your personal tax account at gov.uk to review your codes. Action 2. Maximise your ISA savings immediately. This is one of the most powerful and most underused responses to the frozen threshold problem. Income from an ISA is completely invisible to HMRC. It does not count toward your taxable income. It does not affect your tax code. It does not appear on a simple assessment calculation. You can withdraw any amount at any time with zero tax consequence. If you have savings sitting in a standard savings account earning interest, and that interest is pushing you above the personal allowance, moving those savings into an ISA eliminates that taxable income entirely. The annual ISA allowance is £20,000 per person. For a married couple, that is £40,000 per year that can be moved into a completely tax-free environment. Done over several years, this can substantially reduce the taxable income that sits alongside your state pension. Action 3. The starter rate for savings. Here is the one most people have never heard of, and it is genuinely valuable for pensioners with modest incomes. If your non-savings income, your state pension plus any private pension, is below £70,570, you may qualify for the starter rate for savings. This allows you to receive up to £5,000 of savings interest tax-free on top of your personal savings allowance of £1,000. In practice, if your total non-savings income is close to the personal allowance, but your only other income is savings interest, you could receive up to £6,000 of savings interest with no tax liability at all. The way it works, for every pound your non-savings income is below £70,570, £1 of savings interest is covered by the starter rate. So if your state pension plus private pension totals £1,570, that is £3,000 above the personal allowance, you still have £3,000 of starter rate capacity remaining. For retirees with significant savings and modest pension income, this allowance can save hundreds of pounds a year in tax. Most people in this situation have no idea it exists. Action 4. Manage your private pension drawdown carefully. If you have a SIP or a defined contribution pension in drawdown, the amount you withdraw each year is within your control. Unlike the state pension, which arrives automatically, you choose when and how much to take from a drawdown pension. This gives you a tax planning lever that most pensioners overlook. In any year where your state pension plus private pension income is already close to the basic rate, band ceiling, of £50,270, taking additional drawdown withdrawals pushes you into the 40% higher rate. But in years where your total income is comfortably within the basic rate band, you have room to withdraw more from your drawdown pension at 20% and redirect some of that into your ISA before the tax cost rises. For pensioners approaching or just above the personal allowance threshold, the opposite applies. Taking less from drawdown in any given year, particularly in a year where savings interest or other income is elevated, can keep your total income below £12,570 and eliminate the tax liability entirely. Action 5. Check the marriage allowance. If you are married or in a civil partnership and one partner's income is below the personal allowance, while the other is a basic rate taxpayer, the lower earning partner can transfer £1,260 of their unused personal allowance to the higher earner. The result is a tax saving of £252 per year for the higher earner. It can be backdated for up to 4 years. A potential one-off saving of over £1,000 for couples who have never claimed it. In retirement, this is particularly relevant where one partner receives only the state pension, well below the personal allowance, while the other has a larger combined income. The claim is made through your HMRC personal tax account and takes about 20 minutes. Section 5, the bigger picture. Where this is heading now. Here is why I want you to think beyond the current tax year, because the situation we are describing today is not static. It is a trend that is only going one direction. With the personal allowance frozen until April 2031, and the triple lock raising the state pension by at least 2.5% every year, the gap between the two is closing at a predictable and accelerating rate. If the triple lock raises payments by at least 2.5% a year, starting in April 2027, the state pension is projected to be approximately £12,861. By the 2029 to 2030 tax year, it could be approaching £13,500. By 2031, possibly £14,000 or more. That means a pensioner on the full new state pension who has no other income will be paying income tax on approximately £1,430 of their pension by 2031, even with the government's promised partial protection. Their annual tax bill from the state pension alone, approximately £286. For the majority of pensioners who also have private pension income, the state pension will be consuming virtually all of their personal allowance by the late 2020s. Every pound of private pension income will be taxed at 20% from the first penny. The practical implication: the window for sensible tax planning is right now. The actions I have just described, ISA maximisation, managing drawdown, claiming the marriage allowance, understanding the starter rate for savings, are most effective when implemented before the state pension crosses the threshold and the tax system locks in a higher baseline for your income. Planning in 2026 is more valuable than planning in 2028. And planning now, today, is more valuable than planning next April. Let me bring this back to that number I opened with, £22. That is the gap today between the full new state pension and the income tax threshold. Within a year, that gap closes to zero. Within 2 years, millions of pensioners are on the wrong side of it. Within 5 years, the tax liability from the state pension alone could be hundreds of pounds per year for people who have never thought of themselves as income taxpayers. The government's partial protection helps the smallest group. For everyone else, everyone with any private pension, any savings income, any other source of income, the responsibility for managing this sits with you. The good news is that the tools to manage it are available, legal, and in many cases completely free to implement. An ISA that eliminates taxable savings income, a drawdown strategy that keeps you within the personal allowance in lower income years, a marriage allowance claim that could put over £1,000 back in your household this year. The Retirement Ready UK drawdown planner models exactly this kind of year-by-year tax position, showing you your projected total income including state pension, how it interacts with your personal allowance, and the withdrawals from your private pension that keep your overall tax bill as low as possible. It uses current 2025 to 2026 figures and updates automatically as HMRC thresholds and state pension rates change. The link is in the description. Also check your HMRC personal tax account at gov.uk, review your tax code, and if you have not already watched my video on HMRC tax code errors, the one that covers the £1.37 billion in overpaid pension tax since 2015, that is linked below and directly relevant to this topic. Hit like if this was useful. Subscribe for more UK retirement tax planning content. This is exactly what this channel is here for. I will see you in the next one.